Well, welcome everybody to our Q2 2023 market update call. As always, we have Jason Hillier, John Pastilli, myself, Michael Pastilli, really here to kind of explain what we are seeing in the current economic environment. Go over some data slides, and then of course have that Q&A like we typically do. Just to a couple housekeeping items here. First, lower right-hand corner, you're going to see a chat button. If you go ahead and you can press that, I'll be interacting that while John and Jason are discussing the topics here. So feel free to put any questions, topics, concerns, anything in there, and we'll get that points hit either during the presentation or during that Q&A. So to start out, we're going to start with John Pastilli. He's going to go over the really what we've seen, your guys' current allocations, and what to kind of expect in the next quarter. And of course, Jason's going to come back with Michael advice.
I think we're having technical issues with Michael. His internet's slow today, so I'm just going to take it from here. So as we typically do in these calls, I'll start off by going over kind of what's transpired since the last time we had one of these podcasts. Then I'll kind of go through our current setup. And then I'll go through and say, here's what we're looking at for the next 3 to 6 months, and kind of give you our game plan for what we're currently seeing. So since the last call that we had, frankly, not a lot has changed. You still have a U.S.-centric market that's totally fearful of missing the next rally. So we call that FOMO, or fear of missing out. And so what you'll notice that every time the market goes down, the bulls get in there and quickly buy it because God forbid they should miss, the next bull run. So they're more worried about missing the bull run than to protecting their assets, and potentially what's one of the more extreme quad fours we've ever seen. So that's the setup. They're still buying the pivots, hoping that the Federal Reserve panics and stops raising rates and stops shrinking their balance sheets and so on. I think they're going to be waiting a long time for that, but it is what it is. Obviously, in the last 3 months, we had we had quite a bit of things that happened, but the biggest event was the banking crisis. As a lot of you know, in March, within a space of 3 days, we had 3 of the top 25 banks in asset size in the country go under. 2 of those, well, actually, they were all related to the crypto world, but really 2 of the 3 were really involved in the crypto world. Those are the 2 that we had suggested. Well, actually, we were short both. They both went to zero. So that was Signature Bank and Silvergate. So we called those. They went to zero. We had a big banking collapse. The Fed had to step in. The Treasury had to step in. Once again, they bailed out, very wealthy people. And so now we're similar to 2008 in that, for those of you who remember, you had Bear Stearns go under. The markets thought, okay, everything was fixed. They rallied for about 6 weeks. And then Lehman hit, or 6 to 8 weeks. And then Lehman hit, and then things really got ugly, right? So we had 3 banks go under, a major event, never really happened before other than the 1920s, really. And now we're partying thinking it's all over, when in reality, the problems and the fundamentals keep getting worse and worse. But I'll hit that in a second, and Jason will hit it with the slides here in a minute. So that's, on a side note, we made sure we protected your assets. So we made sure that everyone's accounts was under the $250,000 limit set by the FDIC and all that kind of stuff. We bought a bunch of treasury bills as well to protect you in the case that there was, that the contagion would spread. It didn't spread, but we took precautions anyway. Year to date, January saw a massive rally. We were short. So unfortunately, we're down in the low single digits. Markets are up in the mid single digits. So we have some room to make up here. This is the kind of environment that's very binary. Are we worried that we're that far behind the curve? Not really, because this is the kind of market where within literally a week or 2, things can change massively, like we saw when the banking crisis hit a few weeks ago. Current allocation, cash and T-bills to the tune of about 55%, yielding anywhere around 4.5% to 5%. Bonds, we're starting to build our bond positions, long U.S. government bonds. This is the fourth time we've tried it. The other three we failed at last year. We're hoping this fourth time around is when we make real money. We only had 8% so far in that asset class, but if we think it's going to work this time, we're going to up that to at least 20, 25%. Gold is where we think we're going to make most money this year. We have an 18% allocation currently between gold, silver, and the miners. Gold loves this kind of a setup. For those of you that have been with me, you remember when we got in 2000, from 2000 to 2010, gold went up 18% a year, as I've mentioned in the past, with literally no down years. I'm not saying that's going to repeat this time, but believe it or not, the setup this time is much better than what I saw in 2000. So could it repeat that? I don't know. Could it be better? Could it be worse? No clue, but it could get real interesting, and we think that if we're right, we're going to make a lot of money in the precious metal world this year. Gold is close to an all-time high as of today, by the way, which is, a long time. We're probably going to take that allocation to about 20 to 25%. So we're going to be really aggressively, investing in metals. And then the shorts are about 18% of this market. So earlier I said, this is the kind of market that we can quickly make up room. I mean, if we walk in tomorrow to a 10% downside in one day, we should be up anywhere from 2 to 4%, depending on how gold performs, depending on, how the bonds perform in gold. So that's a setup. Why is gold a good place to be right now? Number one, central banks are buying I've never seen them buy this much gold in a short period of time. So when central bankers are buying gold, you need to pay attention, right? They know what's going on. And they're not buying crypto, they're buying gold. Quad 4, when interest rates drop, is very positive for gold. Inflation decelerating, which is what we're seeing, is very positive for gold. Bear market in stocks is very bullish for gold, and so on. And by the way, we're in a war cycle too. That's also very bullish. Okay, next I'm going to just move into the 3 to 6 months. What are we seeing when we look forward? What are we positioning for? The Hedgeye CEO said recently, it's a quote, he says, "Never has any society had this much debt ever with this horrific kind of liquidity." So what he's basically saying is, we've never seen a debt edifice this massive in any major, economy ever. And the liquidity is drying up. M2 is shrinking, right? The cost of money is going higher. The Fed's shrinking their balance sheets. So just when you need cash in massive amounts to service this debt, the opposite's happening. I wish I could tell you that the bear market is over, but actually we're entering the phase 3 of this bear, which is the worst of the 3. This is where real money gets lost, right? So you look at a day like today, everybody's partying. It looks like, we're wrong, everything's fixed. But in reality, bear markets are designed to suck you in just before they go straight back down. And that's, I think, what's happening right now. So we're in phase 3 of this bear market. We actually sent a link, I think it was Friday or Saturday this past week, of an interview with Keith, the Hedgeye CEO, that if you have time, watch it. It's about 20 minutes long. And in it, he does a really good job explaining the current setup. In there, he basically said that he is expecting a 20 to 30% decline in equities in the next 3 to 6 months. Most folks in this business don't do that because you got a lot to lose, right? It's very easy to be wrong and lose a lot of credibility. So the fact that he said that is kind of notable. So next 3 to 6 months, we're going to continue to stay fairly heavily allocated to gold, to shorts, to bonds, U.S. government bonds, the U.S. dollar, and some selective longs here and there. There's a probability that you may finally see a true investable interim bottom in the next 6 months. What I mean by that is we may, actually flip all of our shorts into massive longs if we see the right setup. And we think we may have a chance of seeing that in the next 6 months if panic finally really hits and we see a true bottom. There's so many headwinds in the next 6 to 12 months. I'm only going to go through a few, but you'll get the gist of it. One is there's a good chance student loans need to start getting paid again. For 3 years since COVID, those payments have been deferred, and it looks like they're going to start up again late summer, early fall. That's a big deal because that's about a $300 a month payment that that tens of millions of people haven't had to make. That's a car payment. You also have the SNAP payments that stopped in March. SNAP payments are, food stamps. So there's 30 million people getting anywhere from $90 to $210 less a month. That's a big deal. The deficit ceiling discussions, right? So we need to raise the debt ceiling again. The last time we had this kind of an impasse was a big deal. The markets went down 20% in 6 weeks. I suspect this particular negotiation is going to be even worse than the last time. So get ready. Yellen needs to reverse a $600 billion money print fest that you did in January. If you remember our January call, we were trying to figure out what caused that rally, and it really came down to Janet Yellen printing $600 billion to fund the government all at once that she effectively stole from the pension system. So now come probably June, July, she's going to have to issue $600 billion worth of debt to pay that back, so effectively removing $600 billion of liquidity out of the markets at the absolute worst time. Earnings are getting ready to just collapse. We're going to see probably the largest earnings declines ever in the next 6 months. That's how skewed this mess is. Employment's getting ready to really plunge. You're starting to see it all over the place now. Employment is a lagging indicator, so you're not going to really see it in the data for probably another 1 to 3 months, somewhere in there. Inflation is going to continue to decelerate. We no longer worry about the inflation. Yeah, it's still high, but the rate of change is decelerating. Venture capital funds and private equity funds have yet to take their marks. What that means is their valuations are based on fantasy. And now that the reality of a credit crunch is occurring, now that the reality that we're in a recession is occurring, they're going to have to reestablish their true marks or their true valuations. And we're looking at anywhere from 30 to 50% declines in that world. And most folks don't understand that that's coming. Commercial real estate is a total mess. 1.2 trillion of debt has to be refinanced in the next 18 months at a much higher interest rate, assuming the banks will even refinance them, which is not necessarily a given. The Fed keeps raising rates into a recession. We're in a recession, by the way. And they're also shrinking their balance sheet into a recession. So that's like putting, gasoline on the fire instead of water. You're just going to make it worse. Mega cap earnings are going to collapse. So that's your Apples, your Microsofts, your Teslas, your Googles. Those companies have a total market cap of about, 7 trillion, which is ridiculous. And they're all in rate of change deceleration mode from an earnings perspective. FOMO is, I mentioned it earlier, Americans are really worried about missing the next rally. What that really does is set up for a crash, right? So everybody's piling into these 9 stocks with this $7 trillion market cap because they don't want to miss the upside. No different than what I saw in 2000 and in 2008. They all pile into the last remaining bullish stocks, and then those stocks blow up, and then it gets game over. Well, we're just about to enter that phase. The fundamentals versus the asset prices, that disconnect is the most I've ever seen. I mean, it makes 2000 and 2008 look like they were rational. Residential real estate is yet to implode, but it started. The credit crunch is here. So that because of what happened to the banks in March, seizing up everything, now we're going to be paying the price for the next few years of a credit crunch. Banks, when this kind of stuff happens, the first thing they do is they reduce their loans outstanding. We'll give you an example. We had a prospect last week who was supposed to give us $5 million. He was refinancing a hotel. He was supposed to close on Wednesday last week, gets a call on Monday from Bank of America, and basically told him, sorry, we were going to give you $26 million on this loan. We're going to give you $21 million instead. And your rate's no longer in the 6% range. It's 7.5%. So this poor fellow spent $100,000 to do all the appraisals and all that, and these numbnuts show up at the last minute and say, sorry, take it or leave it, right? So he ended up leaving it because it didn't work for him. By the way, this is an incredibly profitable hotel, one of the top performing hotels for that particular sector in the country, and they still couldn't get money. So this credit crunch is just beginning, and it's going to be real. The GDP the next 2 quarters, the HEDGI numbers have it going negative. The street's at a positive 1 to 2 number. So think about the shock if and when they were right and the number's actually negative. Quarter on quarter change, rate of change is going to go negative. And the war cycle continues to intensify. I mean, there's a lot going on here, yet the market's rallying. Yet you guys see what's going on. You say, well, it's over, right? The problems are all over. It's time to go party and invest. Well, in our opinions, the risk versus the risks have never been higher, or rarely been higher in markets. So really, at this point, that's why we're so conservative. That's why we have so much cash. That's why we're short. If you really want to go invest in this thing and put 100% of your money in the S&P, go ahead and do it. You're going to get destroyed. We don't want any part of that. And on one last note, we were actually, last night, we were thrilled to find out that we're going to be heading to Connecticut for the HEDGI Live Conference. It's a 3-day event. They asked us to attend because we're one of the few RIAs, I guess, that actually implements their process, in a correct manner. So they want us to kind of go out there and kind of help other RIAs understand and manage, the process. So that was really kind of cool. So on that note, I'll turn it over to Jason.
All right. Thanks, John. John, when I go through these slides, if you can mute it, makes it a lot better with background noise. So, all right. So I'm going to share my screen real quick. Let me know if you can see what I have going.
Yep.
Great. All right, so John's going to kill me if I don't get through this quicker than last time. So I'm going to move it pretty quick and hopefully give you guys a gist and a little bit of background or color to what John had mentioned. I always like to show this. These are the quadrants: quad 1 on the left, upper left, quad 2 on the upper right, quad 3 in the lower right, and quad 4 in the lower left. The line that you're seeing is basically just a meandering line showing you where each quarter is going to hit within a quadrant. And really what I want you to focus on is 2023. And you'll notice, obviously, we're through quarter 1 of 23, which landed in quad 4. We're in the second quarter of 23, which also lands in quad 4. The interesting thing is if you look in the middle, you're going to see two blue boxes, one for the third quarter of this year and one for the fourth quarter. The reason that they're kind of in the nexus or the middle of all 4 of those quadrants is because we don't have all the data quite yet coming out of the government, obviously. So we have to kind of nowcast on where we think this is going to fall based on where the data is trending. And so the probabilities are fairly even between quad 1 and quad 4. My understanding is it's most likely the best option we have is that quad 1 kind of shows its face in the third quarter of this year. We don't necessarily know if that's going to happen. Most likely we're going to hit another quad 4 and another quad 4 for the rest of the year. So it's going to be a bumpy road going forward in 2023. These are year-over-year projections for GDP. As John had mentioned, quarter over quarter, we're actually probably going to go negative in GDP terms. On the year-over-year, we're talking about some pretty small numbers on GDP. And so obviously first quarter, second quarter, third quarter, fourth quarter, you're going to notice that our nowcast models are saying that we're just getting over a 0% year-over-year GDP projection. And these are extraordinarily small numbers, historically speaking. So really no growth to speak of in 2023 in GDP terms. In CPI terms, you're going to notice that we're still elevated. We just came out with CPI, I think yesterday. It was around 5%. And then we have the second quarter, third quarter, fourth quarter, all trending fairly down, not too far apart, still about double what it typically is historically. And these are, again, nowcast estimates for the model. So still higher for longer. Volatility has risen over the course of this year. All this chart is meant to expose is on the right-hand side in the yellow. You're going to notice the MOVE index, which is bond volatility, has gone through the roof. Currency volatility is elevated. U.S. corporate debt, that's elevated. And the S&P is elevated. This is just to show that we've had some pretty volatile times in 2023. Labor in the small business side of things, February marked the 5th consecutive month of job loss for small businesses. So even though, you have the large companies like Microsoft, Apple, Amazon, all laying off workforce, you have to remember 99% of employment is really small business employment. So this is really what you want to take note of. So on the right-hand side, the underlying conditions are deteriorating. So the goods economy, manufacturing, capital expenditures, they kind of build on each other. They're all trending down. Real income for individuals trending down. Confidence, inventories, housing, services, liquidity, margins for companies, and labor are all going down. So pretty nasty stuff underlying the economy. Everybody's calling for a pivot, but is pivot really what everybody wants? That's really the question. And if we kind of look back historically at when, the last part of the hike or the last hike that the Federal Reserve goes through with, and then they start reversing course and cutting rates, does the market really pop higher? No, it actually breaks down. It breaks down hard. And so everybody that yelling for a pivot, wanting a pivot, it doesn't necessarily correspond to a bull market. So you're not getting really what you want. So keep that in mind when or if the Federal Reserve pivots. It's not a green light. This is kind of just a more of a picture version of what I was talking about the underlying conditions that are breaking down. And so think of it below the surface. You have real income going down, savings going down, consumption going down, capital expenditures in the corporate world, confidence going down, liquidity drying up, as John had mentioned, that person that tried to get money for the hotel, and then credit. So these are all locking up. This sinkhole, or what I should say, the surface hadn't caved in yet, but it most likely is going to with all these conditions deteriorating. The lender of last resort, or in other words, the Federal Reserve, has been very busy. And they've been busy by opening the discount window to the banks because of the banking crisis. And so when we look at the balance sheet of the Federal Reserve, what we're going to notice is over the course of 22, they actually did a fairly decent job in quantitative tightening and allowing a lot of these government bonds to roll off their balance sheet, reducing their balance sheet. But, oh, wait a minute. We have a 63% rip back up in the balance sheet because the Federal Reserve opened their discount window to all these banks that needed liquidity. So they erased 63% of what they did in quantitative tightening terms. Now, obviously, you're going to look at this and look at it and say, oh, this is stimulative. It's not stimulative at all. This is totally different. But just know that their balance sheet has now gone straight up. It's hockey sticked to the right. Bank failures have been huge. And as John said, even though there might be 3 banks that went out of business, they were huge. So just 3 months into the year, bank failure total assets are nearly at fiscal year 08 levels, so GFC levels, which is insane in 3 months. So when these banks fail, people look for safer shores. And so a lot of small and mid-sized bank deposits have been absolutely decimated. The second largest drop in 30 years of 2.2%. And they're moving those deposits to safer shores. And so they're going to look for a couple different things. This is not to say that large domestic banks haven't lost assets. They've lost assets. Small domestic banks have lost assets, and mid-sized banks. Problem is everybody's kind of been screwed as these interest rates have gone up. They haven't yielded much on their money market. So the depositors are just leaving the banks that aren't giving them any kind of return for their money, and they're moving it to other areas that they know that they can get a higher rate of return, 4 or 5%. So they're looking for higher yielding alternatives, which is smart. And so a lot of these banks are going to have to up their money market fund, their yields, in order to get these deposits back into the door. Obviously, small businesses are not optimistic. Employment has gone it's gone negative. They're letting people go. So obviously, small business sentiment is worse than at any point, really, other than the great financial crisis. As John had mentioned, CRE lending charge-offs have nowhere but up to go. And what I mean by that is that when we start to see bankruptcies or we start to see banks not get paid back, they're going to have charge-offs. They're really low on this spectrum. If you look at 08, how high it went, we got a long way to go. So we might be just at the precipice of getting really, really nasty. Accounting frauds are rising. When you have a lot of corporations that are zombie corporations, or in other words, corporations that don't have profitability, in order for them to operate, they need money coming in. And in order to get money coming in, they need credit. And if credit's drying up, they're not able to operate. And they do a lot of accounting gymnastics in gray areas, sometimes red areas. And what we're seeing is as these companies aren't able to get credit, they're going out of business. We're seeing accounting frauds run rampant in the industry. John had mentioned this student debt repayment. This might not seem like a lot of money, but $393 is a lot of money when almost everyone's income is going down because of inflation. So this will restart in the next 3 to 5 months, somewhere in the neighborhood of 40 million borrowers. And if you look at some of these charts, you're going to notice that the student loan growth has gone through the roof, but the federal student loan borrowers, which are the individuals that borrow that money, has kind of stayed steady. So we can kind of see how expensive schools become. So student debt reduces spending, it inhibits business growth, it hampers the housing markets, and it stresses social programs, none of which are good. Student loan debt statistics, we have about 1.7 trillion. It accounts for 92.4% of all student debt. It's about 6-7% of GDP of the United States. Right-hand side, historic total national student loan debt. This is a massive part of GDP. Credit card debt delinquency rates have gone really through the roof at this point. We're seeing 30-plus day delinquency rates really rise very fast, which is showing that people don't have enough income to offset what they put on their credit cards. And it's not just credit cards, it's cars. So you're going to see severe account delinquency, 60 days in the orange line, going up into the right, 30-day. It's not quite there, but it's getting there. And so this is with 4% unemployment. Imagine when unemployment gets a lot worse. I mean, this is between credit card and car loan delinquencies. It's going to get really nasty. I want everybody to understand that the U.S. CDS market is under a lot of stress, and this is basically it's basically insurance on the corporate world on whether a company goes bankrupt or not. So you're buying insurance on a company that you may or may not think is going to go bankrupt, right? So when U.S. CDS goes up, right, it's showing that there's stress in the corporate world, and what we notice is that when U.S. CDS goes up, or gets more stressed, that the S&P starts to break down pretty significantly. So as you'll read, the S&P 500 lost close to 20% of its value in the 4-month window between April and August 2011, amid the last debt ceiling showdown, which we are currently in the debt ceiling showdown. So if it keeps rising, if US CDS keeps rising, then the S&P is going to probably track that like it did historically. So keep your eyes open for that US CDS market to blow out. Regional banks aren't the only ones underwater. The Federal Reserve is underwater. If you can imagine, the central bank has swung from a $90 billion a year profit to losses of $42 billion since September. They are losing money hand over fist because of opening that discount window. So they're not the only ones underwater. They're under a lot of stress. The corporate world's under a lot of stress. The commercial real estate world's under a lot of stress. And last but not least, the consumer's under a lot of stress. So as John had mentioned, this is a very interesting time. And that's really all I had. I'm going to stop sharing my screen. John, 15 minutes, buddy.
Way to go, man.
All right. Do we have any questions?
Yeah, so once again, lower right-hand corner of that chat feature, feel free. Go ahead and drop any questions you guys might have. In the meantime, I did get one here already. One of them is saying, why is it taking so long to actually get to the bottom of this, cycle here? I'll just kind of open it up to either one of you.
I'll take it, Jason. So the reason it's taking so long for this unwind is just because of the nature and the size of the bubbles we're dealing with. So we've mentioned this before, we've never as a society or as an economy ever seen so many concurrent bubbles all at the same time, right? So you have it in stocks, you have it in bonds, you have it in crypto, and so on, right? So you have all of these bubbles that are total malinvestment, and the behavior associated with a bubble is key, right? Humans behave differently in a bubble. And so if you look at the behavior, even with these markets, right, some of these companies are going to zero, yet you see them rise 20% a day. I mean, I was short in a very big way, both SI and SBNY, those two banks that went to zero. And in at least 3 instances on both banks, they rallied 20 to 25% in one day. Why? Because that's the bull market's mentality. So long story short, why does it take so long? This could take up to 3 years to unwind because the behavior is so entrenched, and you had a Federal Reserve that for 15 years had your back. Every time you went down, the Fed came to the rescue. So the markets are expecting that again. The Fed's telling them this time we're not going to do it, but the participants are saying, show me. So it's a game of chicken. Right? So why is it taking so long? I use the example of a python, right? Let's say you find a python that's 6 feet long in your backyard, and you're going to try to kill it, and you take the shovel out. Well, my guess is it's going to take at least a dozen or 2 shots to the head before you're able to kill the thing because it's so massive. No different than this bubbles and undoing these bubbles in this economy. So it's incredibly frustrating to everybody, including folks like us who have seen what's coming, and yet we've still had trouble navigating it because of the extreme nature of the behavior. And what I mentioned earlier when I said the FOMO, FOMO, fear of missing out, it could lead to a really sizable collapse in a very short period of time as all these people come to the realization all at the same time that, hey, this game's different. We're wrong. And they all exit at the same time. So that could happen.
Yeah, Mike, I appreciate the comment that you put in the chat here, basically stating that the data seems so clear, but mainstream media doesn't seem like they look at the charts, right? They don't look at the data. So I'm going to kind of phrase this one maybe for you there, Jason. Why is mainstream media still saying it's the consumer's well off, it's a great, the bottom's in, all that fluff, to say kindly?
Yeah, it's pay for views, right? We don't really operate that way. I think a lot of mainstream media, they hit main thematic views in order to bring viewers over and to get them excited and to get them, more enthralled into what they do. So it's not really with mainstream media. It's not about what's correct. It's about what pulls eyes into the program. And it is sad because what's happening is they're programming individuals, like John had said, to buy into this and really talk about how great the consumer is, which there is nothing that's good with the consumer at this point. It's actually really sad. And so when you get Kramer or, somebody else that comes out with a long call, or that the S&P is ready to rip, I mean, that's tough. That's tough to watch because in the background that there's too much data supporting what's happening in the current environment on a negative basis. So I would tell you that, the data seems clear, but they don't really analyze data. They jump from one headline to another and they pull in as many views as they can. And we try to sift through that in order to give everybody kind of the straight poop, so to say.
So the media is paid by advertisers. So like Jason said, they go from one narrative to the next. They're not there to be right. They're just there to sell sizzle, sell the narrative so the advertisers pay the money. But they're not there to be right. So we kind of like the media because without them, we wouldn't be able to take advantage of folks with the wrong data and the wrong information. So we hope Kramer stays in business and CNBC never shuts down because, frankly, they're the ones who make us money.
Mm-hmm.
Yeah, next one is probably a very hot topic, is really with the Federal Reserve. So I'm going to link, Mike, I think you also put this one in as well about, what about the Fed? Doesn't, they don't care about eyeballs or I guess probably what people really believe in that way. But I want to piggyback that one with another question that we got was when or what will it take for the Fed to actually truly have a pivot?
So the Fed is, believe it or not, one of the last ones to know a lot of times. They're still thinking that we're going to have a mild recession later on this year. And meanwhile, we're having a real recession here and now, right? So in spite of the fact that they have 2,000 PhDs on staff, that they pay way too much, they're incredibly poor at data management and understanding what's coming. Horrific, actually. In terms of the pivots, I think Jason mentioned it earlier. A Fed pivoting means that they realize, we're in trouble. The economy's in recession. We went too far. So we're going to pivot. We're going to stop raising rates. We're going to stop shrinking our balance sheets. When that happens, historically, like Jason had said, it actually makes things a lot worse. That's when the true decline accelerates, believe it or not, because they finally realize, hey, we're in a recession. We screwed up. We went too far.
Anything to add there, Jason?
No, I think he hit the nail on the head. I mean, the Fed's always behind the eight ball. I think watch unemployment. I think unemployment's going to be a big factor in that. So as they see unemployment start to accelerate, that's when you're going to see the Fed start to wonder, should we keep rates where they are, or should we start, reversing?
Perfect. So, Jason, I'll throw this one back at you here as well. This is probably potentially our last question, unless somebody in the chat go ahead and put anything else in here. Banking crisis. John, I know you mentioned that before, but since those three banks are we done with this banking crisis, or is there a possibility we're going to see a couple more banks potentially go under?
Yeah, the good thing that the way that the Fed stopped the crisis by opening the discount window was really the only option they had. And so what they basically, all these banks over the years, we had such low rates over the past decade, that in order to create any kind of yield, they have to put those assets or those deposits that they have in a low risk yielding investment. And what they do is they buy treasuries. And so over the course of the last decade, they've had to buy low yielding treasuries. Now, part of the reason SVB went out of business is because they had to sell a lot of their fixed income portfolio at a loss because they needed liquidity. They needed to sell these at massive losses because that was the only thing they really could do in order to satiate the demand for deposits, the outflow of deposits. So what the federal government basically did was they said, all right, listen, you guys don't have to sell your fixed income portfolio. We'll just use it as leverage, and you can come to the discount window and you can take as much liquidity as you want in order to satiate the outpouring of deposits. And that kind of stopped the banking system from imploding. Do I think that the banking system things are over? No, I absolutely do not think that it's over. I mean, here's a great example. Regional banks hold a massive amount of CRE loans. That means commercial real estate loans. I think they hold somewhere in the neighborhood of 65% of CRE loans. All right. And if they have deposits outflowing and they have 65% of their portfolio that has a possibility of imploding, I mean, this is bad news. Like, a lot of these regional banks are going to go out of business. So there's going to be a ton of consolidation in the banking system. There's going to be regional banks, small banks. There's going to be large banks that go out of business. It really depends on, in my mind, on what sector is going to implode and how the Federal Reserve is going to back that. And so I think I think for me, the thing that sticks out the most is that the commercial real estate, as John said, having some really bad issues, and then a lot of these regional banks imploding over it.
Now, one of the things about these banks, this really is interesting, is that these banks, in March collapsed for a different reason in 2008. In 2008, they collapsed because they made bad loans, and they made too many of them, and they were too leveraged. Today, the loan quality is actually, at least until now, fairly good. The way they blew up this time so far is an asset liability mismatch, to Jason's point, right? So you basically borrow, they pay their depositors 0.1% on their deposits, and then they went out and bought treasury bonds or mortgage bonds or that kind of stuff and went out 20, 30 years. So they're paying out 0.1 and they were making 1.25%. Well, that 1.25% of those long-term bonds, the Fed raised rates so fast, and now they're yielding 5%. Well, if I were to sell all of my bonds that I've held for, my 30-year bonds that went from 1.25% to 5%, I'm going to take a 30% face, haircut if I try to sell those bonds because rates have gone up. So that's the issue you have, right? So the banks have had this massive issue of asset liability mismatch, and it's cost them to the tune of about $600 billion of their equity. Guys, we haven't even started the credit cycle. So the next phase of this is where credit starts going bad, and now the banks, now they have to look at their loan book and say, holy shit, I got to take a 30, 40, 50% haircut on my loan book. That hasn't even started. So the collapse that caused the 2008 banking crisis is yet to begin. It's going to happen here again. What we've seen is something we never saw before, which is this asset liability mismatch. So the banks are in serious trouble. They have equity of about 1.9 trillion, and there's a good chance that we're going to use up about 1.4, 1.5 of it between the credit crisis and the asset liability mismatch. So the Fed's created a shit show by raising rates as fast as they did, and by staying at 0% and printing, 95 billion or 150 billion a month forever. They've created this mess. They own it.
Perfect. Well, appreciate that. One more comment that just came in here. As we do try to keep all of our clients up to date, when major events like this banking crisis does occur, we're going to have these a little bit shorter podcasts versus these quarterly calls that are roughly 45 minutes to an hour long. Kind of look out for those. It might be 10 minutes, 5 minutes, just to kind of keep you updated to say, yes, we're aware of X, Y, Z is occurring, and we have your back on that. So I'll turn it over. Any last words before we wrap up this quarterly call?
I would just say there's going to be a bumpy road ahead of us, so be patient. It's going to be, nobody knows, this has been a 15-month, this has been the slowest 15-month train wreck I've ever been a part of. John and I got this gray hair is from the last 15 months right here. I'm lucky I still have it, but we're doing our best to navigate it. We're going to do our best to put out these videos and make sure that you guys are up to date, like Michael said. But it ain't easy, man. This is a crazy world we live in, and so it will eventually. This is eventually going to break down. We don't know what the catalyst is going to be. It could be multiple catalysts, but as you've seen, it's pretty resilient. We've had 2 catalysts already: Bitcoin, and then we've had the banking crisis. And those didn't take it down yet. So it's going to take an army to pull this thing down, and I think it'll happen, but don't know what the catalyst is going to be. That's my last comment.
Yeah, it all comes down to patience, guys. This is going to take a while. The problem with these type of markets is they seem like they go on forever, and then all of a sudden the whole world changes in literally weeks, days, or 1 or 2 months. Like what we saw in March when the banking system seized up. So that's how fast this is going to occur. There's so many alligators in the water. We don't know which one's going to come up and bite us. It doesn't really matter. We're prepared for it. The key is patience. And I know it's hard for you guys sitting there saying, hey, the market's up 7% in January. Holy shit, the party boat's left. It's like, it hasn't left. It's just sucking in more people because we know it's going to hit that, glacier out there, and we're not going to be part of it. You can go ahead. It'll be fun for a little bit, and then it's over. We're not going to go down that path.
Perfect. Well, I want to thank everybody once again for attending, watching this recording as well. As always, all three of us are available, so feel free, email, give us phone calls. We'd be more than happy to describe or explain anything else that you would like to hear. So with that, we're going to wrap up our Q2 call, and we'll be talking to you guys soon.
Thanks, everybody.
Thanks.
See ya.